Take a look at this. The owner who bought a resale unit about a year and a half ago is now sitting on a paper loss of $160,000. Meanwhile, other buyers who enter a new project just 3 to 5 months ago are already seeing 6-figure paper gains. I think it's pretty crazy. Some buyers are bleeding while others are already making good money. If it were you, which side would you want to be on? And as an investor, the real question is, should you buy a resale, rent it out while waiting for appreciation, or just go straight to a new launch that sets the benchmark, which gives you a faster return? Over the past month, I've spoken with a few investors, and one common line I keep hearing is this: hey Kaiser, if I buy a resale condo at a lower PSF today, the tenant will cover my mortgage, so I don't actually spend anything. On top of that, the unit should also appreciate, just like a new launch nearby, since my entry price is lower. On paper, that sounds like a perfect win-win situation. Steady rental income plus future capital gains. But is this really that simple? I have many videos on resale property coming from a HDB upgrader standpoint. In this video, let's break it down from a pure investment point of view with case study and consideration that you should think about before making a move. First of all, resale property definitely have their charms, and it's important to acknowledge the positive. Number one, immediate rental income. You buy today and you can rent out tomorrow. As an investor, it feels great when tenants are helping to offset the mortgage from day one. Secondly, lower PSF and bigger space. Dollar for dollar, resale often gives you a larger unit compared to a brand new launch. Family especially appreciate this. Number 3, faster move in. You don't need to rent a place while waiting for a BUC. The transition is shorter and smoother. And yes, resale prices do appreciate when a new launch nearby sets a higher benchmark. Rising tides lift all boats, and resale often move up alongside new launches. The concern, however, is whether it rises as much or as quickly as the new launch itself. And does it really work out for investors like you who are chasing after gains in the shortest time? That brings us to the first point. One of the biggest selling points of resale is the ability to rent out immediately and let tenants help service your mortgage. But here's the reality. Rental income is never 100% free money. From my experience and what I have seen, there are significant hidden costs and risks that you may overlook as an investor. Number 1, renovation costs. Expect to point at least $50,000 to $80,000 and even sometimes $100,000 if the unit is older or in poor condition. Without proper renovations and upgrade, attracting quality tenant is difficult. Secondly, higher non-owner occupied property tax. As of 2025, the rate starts from 12% on the first $30,000 and it goes all the way up to $36,000 above $60,000. In short, the more rent you collect, the more tax you pay, which can quickly eat into your rental use. Number 3, the monthly maintenance fee. Typically at around $350 to $500 a month, payable regardless of whether you use the facilities or not. Number 4, agent's commission. Every new tenancy agreement usually costs 0.5 to 1 month's rent unless you DIY and find the tenant yourself. Last but not least is going to be the wear and tear repair. Leaking aircons, scratch flooring, stained walls, and water seepage are a common issue that I've seen. A single aircon overhaul can cost you thousands, and water leakage is one of the most frequent disputes with tenants. Over many years, these recurring repairs will quietly eat into your net return. On top of this fixed cost, you still face operational risks such as vacancy and late rental payment. This would mean you forking out the mortgage plus expenses yourself. And when it comes time to sell, you need the tenant's cooperation for viewing. Excuses like I'm not at home, working OT, or overseas can delay showing, and that can cost you serious buyer. Let me give you an example. Assuming you buy a 3-bedroom unit in Normanton Park at $2 million and rent it out at $5,500 per month, and the monthly cost you'll be looking at loan interest around $2,000, property tax $550, maintenance about $400, agent's commission about $230, repairs renovation allowance about $400. Total expenses come out to be around $3,600 per month. Your net rental cash flow will be around $1,009 per month before principal payment. Now, if we include principal payment, the picture change. In total, your outflow for the monthly installment is about $5,100. After deducting rent and all other expenses, you still need to top up close to $1,200 per month from your own pocket. Rental income helps, but it doesn't mean the property fully pays for itself. You still need to commit significant cash flow every month. Now, let's take it one step further. What if the unit sits vacant and you cannot secure a tenant for a period of time? You still need to cover the loan interest, principal payment, property tax, maintenance fee, and allowance for repair. This is a total of around $6,500 out of your pocket with zero offset from rental. This is the real vacancy risk that many investors underestimate when they assume tenant will always be there to pay your mortgage. Now let's talk about the other part of the equation, capital appreciation. We're going to use Normanton Park as our case study. Normanton Park is one of the newly TOP projects with an abundance of supply. How many are we talking about? As of recording, there are a total of 568 listings, of which 142 are the 3-bedroom units type, hovering around 1009 to 2003 PSF. Obviously, there are more sellers than buyers who are looking to exit. As we all know, when the supply is more than the demand, you can expect to find some undervalued deals in the sea of options. Now, here comes the most important question. How much capital appreciation can you expect as a second owner since you're buying at a cheaper PSF? Let's find out. As we can see, many units are appearing in red. Look at this second owner who entered about 1.5 years ago. They are sitting on paper loss, and one of them is down by $84,000. There is a 5-bedroom owner who is down by more than $200,000 in just 2 months. We also can see some of the 3-bedroom owners who bought about 8 months to 1 year ago. They are also sitting on red figure. Let me ask you a question. How would you feel if your investment looked like this? Everyone else is green and yours is red. Now you might be wondering, how can a brand new TOP project just collect key experience a drop in price? How is this even possible? It is actually pretty self-explanatory. Once a project hits TOP and gets key, suddenly you see hundreds of units hits the market at the same time. Everyone is either trying to rent out or flip it, and when the supply is that high, prices get dragged down. On top of that, this is also the point where the monthly installment kicks in for the owners. Before TOP, the progressive payment felt like peanuts, but after TOP, the full loan installment starts. If you're an investor looking to flip, you definitely don't want to fork out this kind of money every month. So many are willing to let go fast, even if it means selling at a lower price. Now don't get me wrong, the first owner are not really losing money. They are still in profit compared to their entry price, just that they are making less because they choose a quicker exit. So that's the reality at TOP. Abundance of supply, all the investors are rushing to exit, and the pressure from monthly installment are hitting them. Which brings us back to the big question. If you step in as a second owner at this stage, buying a cheaper PSF at the peak, how much capital appreciation can you really expect? Remember this, your goal is pure investment. You want to maximize your profit within the SST period while keeping your expenses to a minimum. Imagine you bought this unit 1 year and 7 months ago, and now you're still down by $84,000 without factoring in buyer's stamp duty, legal fee, and other fixed costs that we've just talked about earlier. But what will it look like if we add everything up? Let's look at the number, shall we? Here's the complete monthly breakdown with buyer's stamp duty and renovation spread over 4 years, assuming you're collecting a $4,000 rental income. The loan amount is going to be at $1.215 million. Monthly installment at interest rate of 1.6%, 30 years loan tenure, you'll be looking at 4.2K per month. The buyer's stamp duty, you're looking at $1,054 per month. Renovation cost, and let's say you pump in $50,000 for the renovation, it works out to be slightly just over $1,000 per month. And you have other fixed costs like your non-owner occupied property tax, which is about $620 per month. Maintenance is $350. The total monthly outflow for you would be approximately $7,318. You take this amount minus your rental incomes of $4,000, you'll be looking at a top up of $3,300 per month. In short, even with tenants, you're still topping up nearly 3.3K every month over 4 years. That works out to be $160,000 just to hold this property in the first 4 years. And let's not forget, your valuation is still down by $84,000 after 1 year and 7 months of holding. How confident are you in exiting with a profit when your SST is up? Now let's compare this with a recent new launch, Bloomsbury Residences. Buyers who entered just 2 to 5 months ago are already sitting on a 6-figure paper profit, with prices transacting around 2004 PSF. What's going on here? Why are these early buyers are already sitting in green profit? The answer is simple. Developer price staging. Normally, developers don't release all their units at the same price. Instead, they sell in phases. Phase 1. Prices are launched at the most attractive entry point. In fact, first-day buyers often enjoy additional incentive or early bird discount. At Phase 2, once the project hits around 30 to 40% sales, developers typically introduce a 1 to 2% price increase. This immediately lifts the paper value of the unit bought in Phase 1. And when it comes to Phase 3 and beyond, as more units are sold, prices are generally staged upwards. By then, those who come in later will be paying a significant higher price than those who bought in day 1. We have seen the same for the foreign residences. This developer price staging means that if you enter on day 1, you instantly benefit as the developer themselves pushes the benchmark. What looked like a bold decision to enter early becomes an instant 6-figure paper profit within a month. Now you might be worried if you see a project with low sales number, maybe 30 to 40% sold, and think, if If it's not selling out like those 90% of the projects, is this still a good buy? Or maybe it won't perform in the future. But the truth is, this is actually a blessing in disguise. When a project sells out instantly, all the price hikes get compressed right at the start, and you don't really get a chance to enjoy the price staging. But when sales are steady, developers keep adjusting prices upward in stages because they have confidence to move their units, and that's where you benefit the most. Every time the price go up, the value of your unit increases without you lifting a finger. How good is that? So instead of fearing projects with moderate sales, you should look at them as opportunities. They give you time to enter early and ride the wave of price staging, while others are busy chasing the sold out project that have already priced in the gains. Now it is true, with a new launch, you don't get immediate rental income. That's the trade-off compared to resale. But here's why investors like you still lean towards them. Number 1, progressive payment make cash flow lighter. You don't have to service the full loan installment right away. Payments are staggered with construction, so the financial burden is much lower in the first few years. Secondly, you don't have to fork out much for renovation. Everything is brand new, and families with immediate housing needs are often willing to pay a premium for move-in ready homes. Number 3, stronger own-stay demand at TOP. When the project completes, demand from genuine home buyers gives you more liquidity and better exit opportunity compared to the older resale units. Lastly, you will expect a steeper appreciation curve because the biggest capital growth usually happens in the early years, because you're holding the youngest and most modern asset in this area. That's why for a pure investor like you, a new launch often aligns better with your goal. Lower holding costs, less stressful, and a stronger potential upside. So does it mean that resale is bad? Not at all. If your goal is immediate rental income and you are family looking for a bigger space at lower PSF, resale is still a solid investment. In fact, many families prefer resale because they can move in right away, enjoy a larger layout, and plan for the long term without worrying about the construction timelines. And if you're willing to hold for the long term, resale prices usually do catch up when a new launch in the area push for a higher benchmark. Like I said, rising tides lift all boats. It just takes more time for resale to see the effect. But if you're a pure investor, your goals are usually very different. You're not looking for convenience or bigger layouts. You're looking for sharper growth, less hassle, and a stronger exit opportunity. And that's where new launches suits you better. You see, developers themselves stage a price increase, liquidity is stronger at TOP, and the capital appreciation tend to move faster in the first few years. The key takeaway is this: don't get too carried away by the idea of tenants paying your mortgage. On paper, it looks good because you're collecting free money. But when you dig into all the numbers, you realize all the hidden costs and the operational risk is not really that worth it. Both resale and new launch will appreciate. The difference is the timeline, the scale of growth, and the ease of exit. At the end of the day, your choice shouldn't be about what looks cheaper upfront. It should be about what actually matches your goal. Last but not least, if you find this video helpful, make sure to like and subscribe because I have all the answers to your questions on resale investment that most people don't talk about. Still feeling stuck between resale and new launch? Here's my number. Give me a call. I'm happy to sit down with you, understand your situation, and map out a personalized game plan towards your goal so you can invest with confidence and maximize your next move. My name is Kaizer. See you in the next one.